Well, greetings and welcome back to our second presentation on costs of production. And now we're going to focus on how to categorize costs and then how to calculate some of the different costs. Kia ora and welcome back to our third session on costs. And this time we're looking at what are known as break-even point and shutdown point. And when we come to shutdown point, we're actually going to see how to derive an individual firm's supply curve. But firstly, let's remind ourselves we're in the short run when we draw these curves. In the short run, at least one input is fixed in supply. Now, break even for a firm occurs when it's just making enough or sufficient profit to cover all its economic costs. So total revenue minus total costs. And total costs are, of course, accounting expenses and opportunity costs. So from an economist's point of view, the firm will make zero economic profit. Now this sounds bad, but zero economic profit means that the revenue the firm has earned has not just covered all the explicit or costs, the accounting expenses, but also all the opportunity costs of being in that business. And so we, in the economics cool, the situation where total revenue equals total cost, we call it normal profit. And we'll see as a little bit later that of course supernormal profit is above normal. So economic profit is greater than zero, and subnormal is negative profit or where profit is below zero. Now, let's look at this break-even point. Let's look at the graph. And what you can see here is where break-even point is. Quite easy to illustrate or show where it occurs. It occurs. And let's describe it because you will be asked multiple choice questions about its description where it is. And so here it's at the lowest point of the average total cost curve. Therefore, it's at the intersection point of MC, the marginal cost, and average total cost, because the marginal cost always intersects that point. So MC equals ATC. And if the price is equal to the average cost or the marginal cost, and I've nominated as $10, well, if the firm sells at $10 per unit, it's going to earn $10 in revenue, P times Q for one meal, let's say, if it's a restaurant. And so the firm is pretty happy to sell because it's got revenue of $10, but it's also got costs of $10. They're the same. Remember, total revenue equals total cost. Economic profit is zero. So here, the average cost times the quantity, in this case, we'll say one meal, is going to be exactly the same, 10 times 1, as the total revenue, 10 times 1. So if we put it in these terms here, so the average total cost equals the price. And remember, the average variable plus the average fixed equals the average total. So break-even point, there it is, the lowest point of the ATC curve. And if the price equals ATC, the firm has broken even. In other words, it's making normal profit. Now we move to shutdown point, and in the short run, shutdown occurs when the firm is not making enough revenue to cover the variable cost of supplying or making the good or service. Therefore, the firm will not supply the good or service. If the price doesn't cover the average variable cost of supplying the good, the firm will not supply it. The firm must cover the extra costs of each unit supplied. In other words, the price must at least equal the marginal cost of producing or supplying that output. So in our diagram, we remember that PB is the break-even price. So if they charge this price, they will, let's say it was $10 in the previous, so they will break even. Total revenue, P times Q, will equal total cost, AC times Q. But the question is, will the firm be willing to supply at a price below PB? For example, if the price is $5, would the firm be willing to supply? So you imagine a restaurant normally would charge a price of $10 for each meal. And someone comes in late in the evening, the lights are still on, the ovens are still warm, the cook is still in the kitchen. So remember, these are all variable costs. And so someone comes in, looks at the menu and says, you know, I'm sorry, I haven't got $10, but I've got $5 or a little bit more than $5. Would you serve me? Would you give me a meal? I'm really hungry. Well, economics says, yes, you will serve that person, because the $5 or more that you receive will cover the average variable cost of supplying. So all the people that you have to pay because you're open, the variable costs will be covered by the price and the revenue that you earn. Now, if the price is anything above $5, well, you'll cover all of those variable costs, plus you'll have some revenue to also pay your fixed costs. Now, if you refuse to serve the person and say, no, sorry, I'm closing, well, what happens is you've still got those fixed costs to pay. Remember, it doesn't matter whether you're producing or not, you have to pay those fixed costs. So what we say is that shutdown means, is the firm willing or not willing to supply at that point? So we say from $5, $5, the business is indifferent, it doesn't really matter. But as soon as it goes over that price, then it becomes interesting for the firm, because they will be gaining some revenue to also help pay those fixed costs which have to be paid anyway. So again, the same graph, but this time what we're doing is looking at the total values. So imagine if there was a quantity produced at shutdown point of 300 units, the firm gets $5 for every unit, so total revenue is 5 times 300. Total cost at that point is actually a little over $10, as you can see off the curve, so let's say it's 11. So total cost is AC times Q, so 11 times 300. So total cost is greater than total revenue. And if we want to work out total fixed cost there, we just multiply the average fixed cost, which is $6 times the number of units sold. And if we want to get the total variable cost, we're going to do the same. Average variable cost is $5 times the number of units, 300. So we can also rearrange and do our calculations. Now from shutdown point, we can derive the individual supply curve. And so shutdown is when the firm will not supply the good because it's not making enough revenue to cover the variable cost of producing the good. Therefore, the firm is not willing to supply unless the price it receives is enough to cover the variable cost of supply, average variable cost. So here we can see, that's why we can see our supply curve doesn't start at 0 or 1. It starts at 300 units, because there the firm will get $5, which will equal the average variable cost of producing. Therefore, any price below $5 the firm will not cover average variable cost. As the price rises, the firm will increase quantity supplied in order to increase total revenue. Further, the firm knows from the shape of the MC curve, remember it's rising steeply at this point, past shutdown, that every unit produced, the marginal cost will rise. So the firm is only willing to increase quantity supplied if they receive a price equal to the marginal cost of supplying it. I said I'd revisit this. I mentioned it briefly before when we were looking at the difference between fixed and variable costs. You can see on the left, remember the gap, the distance between ATC and ABC represents the average fixed costs. And so if fixed costs change, the average total cost curve will go up, but of course the average variable cost will not shift. So if you ever asked to show, that's quite rare that the examiner will ask you to shift the cost curves in this model, but if it was to happen, that's the way it will be drawn. However, if there's a change in variable costs, both the average variable cost will rise and the average total cost, but average fixed cost will not change. So the gap between the two curves will not change. Okay, a couple more points. Increasing productivity and efficiency will lower the average cost of production. And we've already looked at the relationship between costs and output, because we know that resources or inputs are employed in the process, so they increase output, but every unit employed adds to costs. So there'll be an increase in output measured best by the increase in average output. Hopefully it's going up, so average costs should be going down when average output is going up. Will be, not should be. So, of course, firms want to lower the average cost of production because that will increase their profit. And increasing efficiency is something they're always trying to do, which basically means reducing the cost per unit or average costs. Sometimes increasing efficiency is referred to as increasing productivity, which is the rate of production measured by the total output divided by the number of workers. Remember that all inputs work with workers, so we can measure the average output of workers to see whether these worker units that are being added are actually lowering the average cost. Three common methods used to make labour more productive. Increased job training and professional development is used widely. Better technology, better equipment to work with, always will reduce average costs. And better organisation of production, more specialisation and division of labour, where people are doing the tasks they're best at, and this often requires just good management. So continuing on, we're looking at the change. If you're asked to show this in our graphs, and you'll remember that if the costs of production decrease, the average cost particularly, the supply curve will shift to the right. And the supply curve, of course, in this model here is the marginal cost curve above shutdown point. And so the MC curve will shift to the right. And because the MC curve shifts to the right, the AE average cost curve will also shift down. Remember, the intersection point has to be at the last point of the ATC curve. So you can see that summarized in below. So a firm is always looking of ways of making its labor more productive, increasing productivity. This not only increases efficiency, but it lowers the average cost of production, which means the firm will make more profit. And finally, we finished just with a word about the appendix. Remember, this has extra slides of what I've run through in the other 3 sessions, and the examiner will not be really testing you on these so much as it's an opportunity for you to deepen your understanding of what has been taught. So, kia pai tora. Have a good day.